Welcome to the Real Estate Show on KMED. June 25th is our date of 2016. Pete Belcaster and Joe Brett, the real estate guys, with you. Thanks for joining us this weekend here on KMED. We're both real estate brokers with John L. Scott in Southern Oregon, and we get together with you once a week here on KMED to talk about all sorts of real estate-related topics and issues. And we've been doing this since the July of 2009, and so far we've never run out of topics on the show. And today is going to be another one of those days where we don't have enough time to fill in everything that we want to tell everybody. Isn't that true?
We could go overtime today for sure. And just thank you to all the folks. We get some great feedback from folks out and about when we're doing our real estate business. And it's great that you're listening and taking advantage of the great guests like we have today.
And you can, of course, go watch any of our past real estate shows. It's pretty easy to do. We're at YouTube or at realestateshowOregon.com. All of our past shows are there, and we appreciate many of you that go back and tell your friends and listen to some of the great information that we have. Okay, well, it's the new year. The new fiscal year is upon us in July the 1st. New money. Everybody's happy around July the 1st. And, CPAs got to be thrilled with what's going on around our state, don't you think? Mm-hmm. I mean, think about that, Joe, because we got new rules. We got money being made. We've got, valuations increasing. And for tax people, they just got to love that. And so Glenn Cunningham is with us here today on the Real Estate Show. And say Glenn's a CPA and a certified financial planner. Once a year we get you here. Nice to see you. There's a lot happened since you were here a year ago this week. Do you know that around?
Yes, Pete,
I'm sorry. Oh, there you go.
Here I go.
I was so excited to hear it. You're not turning up.
Well, Pete, it's great to be here. And congratulations to you and Joe on 7 years. I think this is my 4th year of being on this show. So I've been really excited to be a part of it and look forward to doing this in the future.
Yeah. So what do you think has been the biggest change that you've seen from a year ago in terms of the tax world or real estate and taxes is going around?
The great thing about being a CPA is there's terrific job security because even when things are bad, people still have to file tax returns and still need to plan. And you need to plan when things are bad as much as when things are good. Uh-huh. So for CPAs, good or bad is all relative.
However, the mood of your client differs when they come to see you.
Absolutely. People are a lot more pleasant. What I call it is when people have good problems, they're crying into their champagne glass. And now there are more champagne glasses that people are crying into, which is really good.
Okay, so 7 years ago when we started our show, you were there. You were there at Nagle and Padilla. Anyway,
yes, I was.
7 years ago, we were looking at those MLS stats, and 85% of sales in this county were foreclosed or short sale properties.
People were crying the blues.
You were same way. You saw that same thing.
Absolutely. There were a lot of panicky people. There was a lot of downturn. And many people had no conception of the opportunities for turnaround. Uh-huh. And here we are in 2016, 7 years later, and there's been a significant turnaround. And now people are looking to protect themselves and to plan for the consequences of the gains that are built back into their properties.
And that is because 91% of sales now in Jackson County are regular sales. Yep. And foreclosed and short sales now make up less than 10% of the total market in terms of listings and in sales.
Right. And what Glenn just said is really to underscore it. For about 90% of us, the property that we own is the most important thing that we can call our owner has our future tied to it like nothing else. So planning through those tough times, and then when the time comes, being ready to be able to handle the windfall that comes with a sale. That's really, you've seen it from both sides for sure.
Absolutely. And it doesn't reduce the need to plan, however. The potential good news is something that can turn into bad news without good planning.
Yeah. Now, also keep in mind, 96%, according to the National Association of Realtors, 96% of homes in Oregon are above water. So you're not underwater anymore, which is, again, fueling what you're talking about, Glenn, in terms of making more money, more choices, you better be planning better, et cetera, right? I mean, that makes sense.
Absolutely. Okay. And in the past on this show, we've talked about some of the opportunities there are for individuals to exclude gain on the sale of their personal residence. And those rules are still in effect. And a married couple filing jointly can exclude gain of up to $500,000 on the sale of their personal residence, so long as they meet the other criteria, which is the house has to have been their personal residence for 2 of the last 5 years.
Ah, okay.
So for most people, you're not going to be sitting on more than $500,000
Right.
of appreciation on your personal residence, married filing joint.
Okay. So I'm going to sell, give me an example here now. Follow me on this. So I'm going to sell my house, or I got clients who are going to sell their house or sell a house. Now, if I sell my personal residence and make $250,000 for Chris and I, the tax implications of that?
Under the Internal Revenue Code, that gain is excluded from income to the extent of $500,000 for a couple married who file their taxes jointly.
Okay.
And is that capital gains, or is that taxable
tax
income?
there.
Taxable income we're talking about.
No
tax.
tax.
No tax.
No tax
of any
There
kind.
is no tax.
And Oregon income tax begins with federal adjusted gross income. So if the gain on the sale of your personal residence is excluded from your adjusted gross income, as it is for federal purposes, it's not taxed for Oregon either. But there are very clear rules that the home has to have been your primary residence, which I know yours
Mine
is,
right.
For 2 of the last 5 years.
Okay. All right. And that's what that is. Now, I've got people who have, or clients who have a rental property, okay, an investment property. They don't live in it.
And
if they sell that property now, say, and they don't say you don't own anything on it, and you gain a couple $100,000 on it, not of your personal residence, what happens then?
Then there may be tax.
That may be the tax. Okay.
And the benefit of the exclusion of gain on the sale of a primary residence is what many people consider engineering, social engineering by Congress. Congress is attempting to convince people to invest in their primary residence. And so this rule has been around for a pretty long time now. And so they're encouraging people through this legislation to buy a primary residence. However, if you invest in other than a primary residence, the gain may be taxable. And one of the topics and one of the opportunities for excluding gain on property that's used for trade, business, or as an investment, like a rental, is what's called Code Section 1031, a 1031 exchange.
Okay.
A 1031 exchange doesn't make tax disappear, but it kicks the can down the road. And I'll give you an example.
Yeah.
Say that you have a rental property that you bought back in 2007 for $250,000. And today, that fair market value of that property is $500,000. So you could have a potential $250,000 gain on the sale of that property.
Okay.
If you take the proceeds of that sale and invest them in a like-kind property, and that's
so my $250,000 that I'm going to put into that.
You have $250,000 that you already put into the property. It's appreciated in value to $500,000. So you have a $250,000 realized gain, but that hasn't been recognized yet. You take that $500,000 and you invest it in another like-kind property. You can defer that gain until you eventually dispose of what's called the replacement property.
I can keep 1031 exchanging it, can't I, over time? I can go to the next house and do the same thing again in the next house.
Yeah, and many people, especially in real estate markets that are strong, they may buy a single-family home for $250,000. Over the course of 7 or 8 years, it may increase in value by a couple of $100,000. Then they could take those proceeds and invest them in a duplex. So they go from a single-family home to a duplex. They are able to shelter the gain under the provisions of a 1031 exchange until such time as they eventually dispose of the property.
Now, did you say if I had a rental, again, so because a lot of our listeners, have purchased rental properties over the years and have told us that they're renters. If you sell that rental property, can you 1031 exchange a rental property, or does it have to be my personal residence?
You cannot 1031 exchange your personal residence.
You cannot your personal residence. Okay.
You can. It has to be for trade, business, or investment purposes. So trade or business is say that you
trade a house.
No.
okay.
Trade means conducting business.
Business trade. Okay.
Say that you own a sporting goods store. And you own the building that the sporting goods store is in. The sporting goods store owns the building.
Okay.
You own that real property for trade or business purposes. Investment purposes is if you rent it to somebody. So you buy a property, you rent it out to somebody. That's for investment purposes. So 1031 exchanges are limited to trade, business, or investment purposes.
Okay.
Primary residence is the exclusion of gain on the sale of a principal residence, but a 1031 exchange doesn't exclude gain, it defers gain.
It just defers it down. It's a kicking the can down the road. Have you seen an increase in 1031 exchanges as people filing tax returns now? Is that what you're seeing in this?
We are absolutely seeing that because we are seeing significant increases in property values over what people originally paid for them.
And that's the key.
It absolutely is the key. Is you intend to continue to be a landlord, then the tax code is structured in such a way that you can defer the gain on that property because you're continuing to invest in that kind of activity. Now, there are lots of limitations on 1031 exchanges, and you need professional help in doing it, primarily a 1031 exchange facilitator. And there's a lot of rules, and it's easy to go on the wrong side of the rules. So it's important to first determine that the gain that you may realize on this property is significant enough to want to defer it, and then get some help to make sure that you're not running afoul of the rules.
And what do you got? How many days do you have to do a 1031 exchange? Is it like 90 days or something like that?
There's 2 waiting periods. You have 45 days from the date that the chain of transactions commences to identify what's called replacement property.
Right.
And then you have a total of 180 days to close the transaction on what's called the target property. So you put you put your house, your rental property on the market. You sell it on day 1. You have up until day 45 to identify the replacement property. And then you have to close on the replacement property on 180 days from the day of the original transaction.
Well, I see agents standing up, Joe, in meetings and saying, we got a client trying to do a 1031 exchange. They got to identify. They got 2 days to identify the property. And that's really bad. I mean, when you get to that point.
And that's from my perspective, it's really important for people to understand that 1031 exchanges are not suitable for the faint of heart. But if you have $250,000 in realized gain that you haven't paid tax on, it's worth paying experts to help walk you through the transaction so that you have the opportunity to defer that gain.
Okay.
I have many clients who invest in 1031 exchanges and have been investing in 1031 exchanges since their parents died. Okay. And they intend to continue to 1031 that until they're gone and the property moves into the hands of their children. So it's for those clients, it's not only a deferral of gain, but it's an estate planning strategy because the children inherit it at the stepped up value that the property the fair market value of the property on their parents' date of death.
So I just want to make sure that I get this for our listeners is that if you own your property and you sell your property, Joe, you sell your property or I sell mine, and we're going to gain because, as Glenn is saying, everybody's above water, you're going to gain. So we're going to gain. But if I sell my own property and I do gain $250,000, $300,000, $400,000, I get to keep that. Is what you're saying. That's not a taxable.
Married filing jointly.
Your primary residence.
My primary residence is the key.
Yes.
But if I own rental property and I want to sell them, and I sell them, it's a house, whatever, I am going to have to probably pay a capital gains tax on that, or I can 1031 exchange that property.
Right. The key words. The key words are exclusion and deferral.
Okay.
On the sale of a primary residence, you can exclude from income. That means it disappears from income up to $500,000
Gee, I
married
like that.
filing joints.
I like that disappearing from income of $500,000. That's a pretty good deal.
That's hard to do with the IRS. Has been my experience.
And be legal. Yeah, and be legal.
So a little bit of social engineering.
Yes.
And then on property that's for trade, business, or investment, you're not excluding it from income, you're deferring it.
You're just deferring it.
Right.
Yeah.
So going from disappearing to kicking the can down the road.
Uh-huh. Well, I can certainly see why people would do that. And I can see why, into the current condition that we're in, why you're seeing that type of thing coming when people filing taxes.
Have those thresholds gone up? It seems like the capital gains were more.
You're going to have to hold that off.
Yeah.
We got coming up here. We've got a break coming up here. But when you hold that, we also want to talk to Glenn coming up about what recreational marijuana business has done in taxes and how that all's played into real estate. And Glenn's got he's got some experience on that in the last year as well. All that, still the Real Estate Show here on KMED. We're with Glenn Cunningham from Nagel and Padilla. He's our CPA and certified financial planner. Talking real estate and taxes. We're coming right back to KMED in a minute. The Real Estate Show continues here on KMED. June 25th is our date today. Pete Belcaster and Joe Brett, the Real Estate guys, with you. Don't forget, you can check out any of our past shows at realestateshoworegon.com is our website there. You can also get a hold of Joe or I for any real estate information. We'd love to share it with you, and so we love talking with you as well. So welcome to our show today. By the way, Joe, they figured out Barbara Brown down at the John L. Scott office is really cool at making these market snapshot reports that agents really use. And I just wanted, before we continue with Glenn Cunningham, just to tell you what the market is actually doing here. If you're in the This is Jackson County overall, and it changes, by area, neighborhood, and stuff. But overall, Jackson County, if you had a listing in the 150 to 250,000 price range, there is now the lowest I've ever seen it. There's a half a month supply of inventory out there in that range, from 150 to 250. If you're in the price range of 250 to 350, you've got a 0.8 month supply, less than a month supply of inventory across our county in that range. You go from 350 to 500,000. Now you start to climb. You got a month and a half there. Still not very much. And at 750 and higher, well, you got over a year's supply of inventory. But it's those low areas, Glenn. And I'm telling you, we're getting multiple offers, and the supply and demand here is real estate right now is something that we've never seen. There is just so much demand. They're buying, but they're not being replaced by enough listings, and so the gap widens, and we're seeing pressure on prices, and appraisals are coming in low. And it's all over the board in terms of what the market is doing right now. It's really interesting to watch it, as our listeners know. Anyway, we're with Glenn Cunningham. Today is our certified public accountant and our certified financial planner from Nagel and Padilla. It comes to us once a year here on the Real Estate Show. Well, you talked about, capital gains, and that really cleared it up for me a lot there. I hope that people understand that. The newest thing, I suppose, that you have to deal with has got to be taxes in recreational marijuana and the new businesses and the new people who are moving here to do this. And what in the world, I don't even know how you even start or where you start in terms of dealing with taxes and how you pay for people who are doing this. Because let's face it, this is going to be $1 billion industry in our valley. It's already there. And it's unregulated. It seems like it's just
the banks are not participating. It's a cash-driven business, which can be a CPA's nightmare.
If I'm a marijuana grower, do I even want to come and talk to you?
Well, that's your choice. But I have to advise people that in normal circumstances, every business person should be rock solid on their books and virtually audit proof. It's even more important in a marijuana business because the regulatory environment for marijuana is so nebulous. It's so gray.
There's gray area everywhere.
And most of the gray doesn't have to do specifically with Oregon, because Oregon seems to be moving very much on a path towards legalization. And I believe that recreational sales exclusively outside of medical marijuana dispensaries will be available after October of 2016. So things are moving along pretty quickly from an Oregon perspective. Okay. The gray area is the disconnect between federal law and Oregon law.
Okay, yeah.
And for federal law, Oregon is considered a Schedule I controlled substance. So marijuana has for federal purposes, virtually no difference from heroin.
Okay.
All right. And heroin is completely illegal here in Oregon, but marijuana is legal for Oregon. With the implementation of the new laws, Measure 91, people can grow their own marijuana for their personal use, have marijuana for their personal use. They still can't smoke in public, but they can grow their own marijuana for personal use. So from Oregon perspective, it's legal.
Have you met people, Glenn, coming into to our state just to do that? I mean, we've talked with people, and we've met people who've moved here for just those reasons.
I have, and it's unfortunate, but I can't tell you how many people have written the check, put down the money, bought the property, and then find out how hard it is to be in this business.
Right. Yeah.
And the significant disconnects are not only federal law, it's not only an illegal substance for federal purposes, but it affects the income taxation of the income that you generate if you are in the recreational business.
And are growers paying a tax now?
Growers should be paying tax now because they're operating a business, but they need to do their bookkeeping and account for things separately for Oregon purposes from the way that they do them for federal purposes, because there are limits for federal purposes on things that you can deduct, items that you can deduct from your income. So and I don't want to throw a lot of numbers out here on the radio, but if you have $250,000 in sales, marijuana sales, $50,000 in cost of goods sold, and $100,000 in other expenses, things like paying the utility bill and administrative and salaries. So you have $250,000 in sales, $50,000 in cost of goods sold, and $150,000 in other expenses. You've got $250 minus 50 minus 150, which should be $50,000 in taxable income, right?
Okay.
But for federal purposes, the only expenses that you can deduct are the cost of goods sold. So for federal purposes, instead of having $50,000 in taxable income,
you have $150,000
plus the $50,000 that you have under normal accounting.
Now, are people going to come to and pay that? Are you seeing anybody pay that?
It would discourage them, I would think.
I would think so too.
Well, you need to be planning to enter this category, understanding that your taxes are going to be higher for federal purposes. But you also need to enter this business not only knowing the differences for tax, but for the other aspects of it. Because it's an illegal substance for federal purposes, banks are reluctant to offer you bank accounts. Credit card companies are reluctant to extend credit to you. And so you have a situation where you're managing a very, very large cash business.
Absolutely.
You have the issues of collecting cash,
holding cash,
storing
cash,
transporting cash,
spending cash.
You can't
even spend it.
How do you cut a payroll check for somebody who is helping you sort and grade?
You don't. You pay him cash. I mean, you pay him cash under the table, probably.
Well,
see, that's what's going to get people in trouble, I think.
That's what had the potential to have people in trouble in the past. And one of the challenges that people face is because the rules were so complicated and so hard to understand, many people operated this business under the radar.
Right. And they're trying now to make it legit, right?
Move into the sunlight. And it's really hard
and they can't do it
to move into the sunlight when you existed in the shadows prior to the implementation of Measure 91.
It seems the federal government would stand to benefit from getting up to speed with times, because it just seems they stand to lose so much. They're creating a system for these taxes to not be paid, or for them to not realize a full fair benefit that they should from the industry.
You're preaching to the choir, Joe, but the bottom line is
and we're in the West Coast, folks, and that's a different. Believe me, down in Texas, they look at us like we're like crazy people up here by what we do, or in the, a lot of places. So it's where we're at.
There are some reasons that they would think that way.
Yeah.
But when you look at the United States population, Colorado, Alaska, and Washington are the only states that have recreational marijuana legal.
Mm-hmm.
There's 47 states that don't even have it as legal. There are many states, I don't even know what the number is, that don't have medical marijuana as legal.
Yeah.
So there is a great disagreement at the state level, and we've seen very, very many changes in federal law over the past 20 years. But one thing I'm very certain of is federal law doesn't change until the states move in lockstep to change their own laws.
And that's why this is not going to happen for a long time still. In terms
we need
of
to plan like it's not
things.
going to happen.
You need to call Glenn and get your ducks in a row.
And so people trying to do this who are buying property, trying to get into legitimate business, they're up against the wall with this thing, and I don't know if there's any way out for them at the moment. So you're right. You got to go see someone like Glenn to make sure you're doing it right. The Real Estate Show, one more segment to go here on KMED. We're coming right back. Hey, right after this. Real Estate Show rolls on KMED. June 25th is our date. Hey, we've got 4th of July weekend coming up next weekend. Hope you're going to enjoy that. We've got a big John L. Scott Client Appreciation Party coming up on June the 30th up at Roxanne. That's a big event where several thousand people get together and celebrate real estate, I think, in Jackson County. A lot going on. You can check out all of our shows at realestateshoworegon.com. They're also available at YouTube/Real Estate Show Oregon. Today here on the show, Glenn Cunningham, who's a certified financial planner and CPA from Nagel and Padilla in Ashland, is here on the Real Estate Show. Glenn comes and joins us once a year. And so far, man, we've learned a lot today, Glenn, just about in terms of capital gains taxes. If you sell your own residence versus an investment property, it's very different for people. You've talked about marijuana world and recreational marijuana and what that is doing to business and taxes and all that kind of thing. What do you think the future of that's going to be for growers and the business itself? Because we're seeing the creation of a new business coming, as you say, out of the shadows and into the light. What do you think is the future going to be for this? What has to happen for it?
So today, there are many tax consequences of having a marijuana business. And a marijuana business for federal purposes can pay significantly more tax than other types of businesses. Tax, however, is only one of the issues that people are facing. They're dealing with cash management issues, payroll issues, banking issues, personal safety issues from having to hold and transport that much money. And certainly there is the potential for criminal prosecution because of the disconnect between federal law and state law.
Yeah, the risk.
So there is a lot of risk. Presently, there is some movement in Congress. I don't know how far it's going to go. Between representatives from Oregon and Colorado have proposed legislation to change some of the most onerous aspects of the disconnect between federal law and Oregon law.
Banking seems to be the biggest.
Banking is a huge problem, and it's one that people are becoming really creative about finding solutions for, but each of those solutions end up costing the business person more money than for what is a fully legal business from a federal perspective and a state perspective.
Have you ever seen anything quite like what we're going through here in Oregon with this in your years of experience?
This is really amazing to be operating in an environment. It's almost as if at the end of Prohibition, whiskey was only legal in 3 or 4 states, and it remained illegal in all of the other states.
Yeah, well, we still had I'm still concerned, and you talk about banking and the kinds of things in that part of the business. I'm concerned about in terms of the rush on rural properties and the gold rush that's kind of going on, that people, although I think it seems to be maybe sobering up, people are kind of realizing that maybe it's not what it originally maybe they thought it was going to be, and maybe smarter heads are prevailing. I don't know that for sure, but it would sure seem that would make some sense here with this new business that we are creating here in our valley.
And we may be able to know more about the situation after recreational marijuana becomes fully legal for retail sale purposes. Right now, it's on a very, very limited basis. But in the meantime, growers can do a lot to protect themselves. They need to understand that while recreational marijuana is legal for Oregon purposes, it's not for federal purposes. The risk, however, of criminal prosecution, I'm not an attorney, but the risk of criminal prosecution is probably lower than the risk of not reporting revenue for tax purposes.
Now, if these guys and girls who are doing this, if they're all have to register with the state, so the state knows that they're there, they know they're producing income, they know it's there, so they would be smart to step up, pay the taxes, get somebody like you, and take care of it. I mean, if I'm in that business, that's what I would do, wouldn't you? I mean,
so I haven't gone through the OLCC process myself, the licensing and registration process, but I doubt you can make it all the way through the process unless you can document your efforts to be legitimate before Measure 91 passed.
Just coming out of the shadows and saying, I want to do this doesn't necessarily get you what you want.
You need to have operated
really
in the... Yeah,
you got to be legit here, don't you? You can't just be underground and come out and say, I want to do this now. You got no track record. You've got nothing to show for it.
The inclination is to stick your head in the sand. Yeah. The reality is that the way Oregon has structured the law, it makes sense to have been above ground.
Yeah, absolutely. I think that's really good advice. What else you got for us? We're almost out of time. I know you talk about pass-through monies and things like that. What do you got there for that?
Oregon passed some legislation in 2013, 2014 that changed the tax treatment of pass-through income. Pass-through income is, say that you're a shareholder in an S corporation. So you have a business that operates as an S corporation.
Okay.
If that S corporation employs Oregon employees who aren't you or a member of your family, so unrelated employees, Oregon has implemented a significantly lower income tax on that income.
Interesting.
So legislation has lowered tax rates on certain kinds of income for business people.
Okay.
So it's really important if you do have an interest in a partnership and you employ people, or if you do have an interest in an S corporation and employ people here in Oregon, to understand how that affects your Oregon tax liability and to make sure that you're working with your tax professional to ensure that you are on the right side of this legislation, and that if you are on the right side of this legislation, and that you're taking advantage of the opportunities to save on income tax.
Yeah, saving on taxes is really good. It's when we start writing those checks now. And I bet most people, again, people are not underwater. The economy is doing well. So there's more money out there being generated, and of course that produces more tax, more et cetera, et cetera. So you've got to be careful there.
It creates a whole nother set of problems.
Yeah.
They're good problems to have, not bad problems, but they're problems that need to be planned for, and they need to be addressed in advance.
Have you seen your clients selling property, selling land quite a bit more than you have seen in the past, Glenn?
Well, as you know, we have quite a diverse array of people moving here from the Bay Area.
All over, really, yeah. Bay Area, yeah.
and so real property values in the Bay Area, if we feel like prices have gone up here in Southern Oregon, they have grown astronomically in the Bay Area.
Yeah.
And so we're seeing a lot of people who exceed the principal residence exclusion of gain that you and Joe and I were talking about earlier, because they're paid for their home, their primary residence, $100,000 25 years ago, and they sold it for $2 million.
And now that's outside that $500,000 capital gains that you would do, isn't it? Absolutely.
Absolutely.
Tax on that, yeah.
But whether your house sells for $1 million, $500,000, it's important to document what you paid for the house.
Yep.
It's important to document the improvements that you put into the house.
Absolutely.
Because all of those costs reduce your gain.
Yeah.
Whether you pay tax on the gain or not, it's important to document, because you really hate to have to pay tax that you don't need to pay.
We don't want to pay tax we don't need to pay. That is good advice for sure. Glenn, we got to go. NagelAndPadilla.com is their website. They've got blogs. They've got there. You can check Glenn out. You can Google him. He's great to talk with. He's the smartest CPA I've ever known. And thank you for your great advice.
Thank you very much.
That'll do it for the Real Estate Show for Joe and Pete. Hey, have a great weekend. We'll talk to you next Saturday, the great 4th of July.
You've been listening to the Real Estate Show on KMED AM and FM radio, presented by John L. Scott Real Estate of Southern Oregon, along with All Cities Property Management, the Home Builders Association of Jackson County, DiTech Mortgage, the Jackson Soil and Water Conservation District, and the Rogue Valley Association Association of Realtors. For guest information or to watch a past show, visit us online at realestateshoworegon.com. Join us again next weekend for Southern Oregon's one and only real estate show on KMED.